Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Senior Technical Analyst with Market Rebellion, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As I zoom in here, you'll see that I left my zip lines on the chart from last week with my upside target of 334.37. Keep in mind that we still have 2 days left in what is historically known as the year-end rally window. That's the last 5 trading days of December and the first 2 trading days of the new year. Remember that Monday the markets are closed, so the window for the year-end rally closes on Wednesday, right? So we have Tuesday, Wednesday is the first 2 trading days of the new year. Today we have an interesting candle right there. That's a hammer pattern. And that candle has a long shadow underneath. That tells us that the buyers fought back right towards the close. And we closed that right on the highs. That's very interesting because we also see a higher volume on that bullish candle. And the stochastics are still heading higher. The CCI is kind of floundering right there, mid-range, but the momentum still looks like it's shifting a little bit higher. Now, remember, like I said last week, I am not putting on my bullhorns. I'm expecting a test of that 20 period moving average, and then I think we're going to head right back down in a pretty big way in January. I'll get to that in a moment. But my forecast for DIA stands the way it was last week. I'll update that perhaps on Wednesday during the midweek report, but that stands, like I said. Now, IWM, if you take a look at this, similar situation where we have a green candle, momentum is shifting higher again on the oscillators. That moving average above the market is again going to act as resistance. I still have my target on IWM from last week. Right there, I'll bring up that little data box at 176.12. So nothing has changed right there. Remember, if you're taking any new long positions, like some of our option traders did this week, you have to be very quick to take your profits and protect in case the market starts shifting against you. I'm a big advocate of managing risk, and 2023 is going to be the year of the 1% rule. I'm not going to stop promoting that risk management rule that I created in 1988. It could be a lifesaver for you, a financial lifesaver, that is. Now, if we look at QQQ, this is a tech sector. Again, we have a full-fledged pivot point yesterday. We have a slight lower high, but we have that shadow underneath that candle. Again, oscillators are still moving up. Not quite sure Qs are going to get all the way up there to 273.39, but I'm going to keep that in place because we still have a fairly wide divergence between the price and the moving average. So that target is in place, and it stays there until we either change that or hit it. So SPY, let's talk a little bit about the S&P 500 ETF. Again, we have a hammer pattern right there. You see me magnifying that. Upside target still in place at 386.71. Stochastics is heading higher. The volume is also heading higher, and we have a slight gap still above the market. So that's SPY. Before I get to the VIX, I want to show you something and why I am still very bearish for 2023. If we take a look at a monthly chart here, you'll see that we have a bearish engulfing candle, followed by a bearish engulfing candle, followed by a bearish harami, followed by, guess what? We closed this month with a bearish engulfing candle. If you go back and look at the history, you'll notice that the beginning stages of these bear markets had very similar patterns right here. You see this bearish engulfing as it was trying to make its way up over that 20-period moving average and then failed. This was the big move in 2008 where we accelerated in that bear market. And I think we're going to see the same thing happen in 2023. If I go back to 2000, again, look at the footprints. They're there. We started with bearish harami here. We had a bearish engulfing here, followed by a bearish engulfing and failure to get over that 20-month moving average, and then another bearish engulfing. And then it continued to get punished right for the following 2 years after we broke out below that 20-month moving average. So again, I'm going to give you my targets of the major markets at the end here, so stand by for that. But again, history tends to repeat itself over and over again. We have not seen capitulation yet in this market. I do believe that 2023 could be the year that we capitulate, or at least investors capitulate. We're going to be making money on the way down with our put spreads. If you're interested in learning more about how to trade options on the way down, just contact Market Rebellion. Get plugged in. Look at the webinars, follow my trade alerts, ask questions. We have a Q&A forum. You could ping me, and I'll help you get those questions answered. So again, upside target right there, still in place for SPY 386.71. Now I'm going to look at the VIX real quickly. We have a red candle, but that is a long shadow on top. It's more or less a neutral candle because it's right on that moving average. But look what we have here. We have an upward trend on the CCI, and the stochastics looks like it's starting to go sideways. So it's pretty neutral. I still think we could drop a little bit on the VIX, and then once the VIX hits a support level, I think we're going to take off probably in the second week of January. We're going to start to see some heavy selling. And that is the major markets. Now, if we look at some of the geopolitical news out there, you have to keep your eye on China. I keep telling people, look at China, look at China, look at China. We have the PLA, this is the People's Liberation Army, is sending warplanes near Taiwan. This tension continues to increase. We don't know how that's going to affect the markets until something breaks there, but keep your eye on that. And another thing, I mentioned this a couple of weeks ago, I'm still long-term bullish on energy. This article came out today through Reuters and talking about how London oil rose today, and it's really contributed to the Ukrainian war and the weakening demand for the world's top crude importer, China. Now, I think that's going to change. We were talking about this on a roundtable discussion earlier this week, where now that China is opening up and lightening up on those COVID restrictions, they might see some more travel, might see some more oil consumption there. We'll have to keep an eye on that. And this is something that is extremely interesting here. We have a report that's showing U.S. pending home sales. This is the biggest crash in pending home sales on record. Take a look at that. That's a leading indicator. Have to make sure that you're paying attention to what's going on around you, and don't just follow, the financial programs and what their narratives might be, because they tend to lean bullish all the time, and they're not going to really do you any good if they're talking you into buying the market when the economic indicators are looking so weak. Speaking of economic indicators, I would encourage you to go to www.conference-board.org and look at the leading economic indicators. And they have an index here that is giving us a lot of information and signals that are pointing to an approaching recession right here. Go and read that whole page at that website. You see the link down below. Just go right there. I'll put a link to that in the description box below, but that's worth your time reading that, and they give you some good charts to look at as well. Now, there's one fellow that I'm following on Twitter here. He's calling himself the car dealership guy. This is something that no one's talking about, at least not yet. He's talking about how the dealers are allowing people to take out a second loan on a new car. And you have to understand that this is very similar to what happened in 2008 with mortgages, where they were issuing mortgages to people that had no business taking out a mortgage. And in fact, it was anyone that could fog a mirror would get a mortgage. And that led to the real estate bubble breaking. This is very similar. It's in the new and used car market. This is not a normal practice where the dealers allow you to take out a second loan. The main reason is that the value of the cars have dropped so much that the dealers aren't able to work that into a new loan for the buyer. So they know full well that if a buyer is taking a second loan on a car, they're most likely going to default on the first. And that's not a guarantee, of course, but if someone's upside down on that first car they'll let it get repossessed. And we're really at the risk of seeing that happening. You can see down here later in the thread, it says there'll be tons of repossessions. I tend to agree with that. I'm not a car dealership expert by any stretch, but go on there and read what he has on Twitter. He's putting out weekly reports and information that I think is very relevant to the overall markets. Now, what are my targets for 2023? Here they are. Diamonds, 240 on the downside. QQQ, 200. Spiders, 300. IWM, 130. Now, keep in mind, these are not the 2020 lows that I've been forecasting. I do believe that ultimately we're going to hit the March 2020 lows right across the board. But this is my conservative estimate for the downside. You could mark those on your charts. You could put price alerts if you like, but I'm putting this out there for the record so everyone knows where my targets are, because I make everything public. I record everything. I could always go back and listen to an archive or pull up information that I've mentioned in the past, and people could verify my targets. Just like on January 19th, we recorded a webinar where I called the end of the greatest bull market in history. That was on January 19th, and I started to establish the top pattern that was forming. It was more or less a head and shoulders pattern that was breaking the trend lines. And I like to record this for the record so everyone can see where I stand. And it's also a great lesson, so you can go back and listen to the recordings, look at what I've been looking at that time when I'm looking at the charts, and then you could duplicate that yourself. This is not rocket science. It does take practice to learn how to read the charts, but that's what we do at Market Rebellion. We teach people how to look at the charts, trade options, manage risk, and as a community of market rebels, you have a great resource of people surrounding you in these memberships that we have through Market Rebellion. So I want to wish each and every one of you a very happy new year. This 2022 went very quickly, and I hope 2023 slows down just a little bit, but I have a gut feeling that 2023 is going to be one of the best years we've had in a very long time, and that's because we're positioned for this bear market. So have a great weekend, and we'll talk to you next Wednesday. So long.
I mean, you take a beginner and someone who's a little naive and doesn't really understand how options and stocks work, and then you can actually educate them to have more knowledge than a lot of the brokers. Brokers don't even understand a lot of stuff you guys teach. In fact, I just talked to a broker. He says this is the only place that's taught in America.